Morning, right, we'll get started. So hopefully everybody is here to hear us talk about understanding investor behaviour in uncertain times. My name's Esther Carter. I'm a partner at Moore Kingston Smith. There are some familiar faces today who've joined us, but for those of you who don't know us so well, Moore Kingston Smith is a top 10 audit, tax and advisory firm. We work with many different businesses across lots of entrepreneurial sectors, as well as not-for-profit and private client. And we're also part of More Global, which is an international network with a presence in over 100 countries. So very well placed also to help our clients in their international ambitions. It's probably fair to say that the markets feel fairly noisy at the moment. Maybe every time you're sort of scrolling through your mobile or looking at the news, there's another headline on what's happening in the markets and perhaps why you should be worried about something. And periods of market volatility inevitably create uncertainty and emotional reactions as well. So often leading investors to make sometimes costly short-term decisions. So in this session, we're going to sort of step back from the headlines, we're going to step back from the technical detail, and we're going to focus on what really drives investor behaviour, particularly when the markets are feeling unsettled. So we're going to look at some of the common behavioural traps that can undermine long-term outcomes and highlight why sort of discipline and perspective really matter far more than market timing, and therefore how successful investors can stay on course when the markets are very noisy. So I'm delighted to be joined by David Painter. Now, just to say before we start, today's discussion is focused on general behaviour rather than long-term principles. And rather than any sort of particular personal recommendations. So David is a chartered financial planner and director at Moore Kingston Smith, and he heads up our financial planning team. And our financial planning and employee benefits team consists of around 50 people. They help corporate clients, private clients, trusts, charities and individuals, and collectively advise on just under £1 billion worth of client assets. And they also hold the Chartered Insurance Institute's corporate chartered status, which is a bit of a mouthful, but is also a mark of professional excellence for insurance and financial planning firms. It signifies a public commitment to ethical standards, client-centric service, and ongoing professional development. So alongside sort of leading the team's strategic direction, David also very much remains a hands-on advisor and works very closely with his clients. He takes a highly personal approach to financial planning and really helps clients focus on what really matters to them, putting in clear, practical plans to achieve their long-term goals. And he's known for his very down-to-earth style and clear thinking. We can all judge on that later, David. So before we begin, a couple of really quick housekeeping points. This webinar is for you, so please do interact, please do ask questions, pop your questions in the Q&A function. They're much easier to keep track of there, and I'll try and weave those questions into the questions that I already have for David. If we don't manage to answer all the questions, then we will pick them up at the end, as long as they weren't submitted anonymously. So if you want them definitely answered, then don't be anonymous. Today's session is being recorded, so please feel free to share with peers and other people who weren't able to make it today. And also there'll be a very short feedback survey that we will share after the webinar, and we'd be very grateful if you could complete that because it really does help us to shape future webinars. So David, let's get started. So first question really about sort of market volatility, which is something that we're all very aware of right now. But, you know, is market volatility sort of a normal part of investing, or is it something that investors should be a little bit wary of?
Well, actually, first of all, good morning, everyone. Thank you very much for coming on to this webinar. Yeah, volatility in markets is absolutely normal, and it's been around for a long time. And I'll look a little bit at the history of volatility. When it comes to investing, it's not the fact there is volatility; it's how we actually react to that volatility, and that's going to determine whether we're going to be winners or losers. And hopefully, over the course of the next 30 minutes or so, we'll talk through some of the key triggers as to why we as humans behave in certain ways, and I suppose some of the pitfalls to avoid, and maybe some of the opportunities to have a look at. So I've been doing what I've been doing for about 30 years as both an advisor and an investor. So I've been sitting on both sides of the fence as such. And
Mhm.
I want to take you back probably, I'm actually going to go back about 50 years ago and have a look at a few of the events in the past that have triggered certain sort of shockwaves around global financial markets, why that's happened. And the reason I wanted to go back 50 years is because back in the 70s, we had the oil crisis. Now, the oil crisis had a significant impact on the markets, 40 to 50% drop in some asset classes. It then fed through into the wider economy with inflationary shocks, and that might actually resemble with what's going on today. We've got some tensions over in the Middle East, and so there might be concerns for investors about what that impact might be to our longer term plans. Back in the 80s, we had Black Monday. Now, actually, back in the 80s, I was young. I was more interested in things like windsurfing. We had the big storms coming over into the UK, so I wasn't worried about Black Monday. But a lot of investors were, and that was a huge panic. Markets fell by about 22% in one day. But I think one of the things to learn from that is sometimes when there's a short-term fall, the recovery can be quite quick. And later on, I'm going to talk about why we shouldn't let our emotions dictate what we do in those sorts of periods. In the 90s, in the UK, we had the ERM, so the exchange rate mechanism, and so we had a lot of volatility in the UK exchange rates. And then coming a bit closer in the early noughties, we had the dot-com. Now, again, that might resonate with you now with the sort of surge of AI, and are there any similarities? And I was thinking about the dot-com, and there's one company in 2000 was worth about 30 billion. There was lots and lots of hype. People sort of plowed their money in, and then about a year later, it lost about 96% of its value, and people panicked. They sold out. Um, that company today visit my house pretty much daily, and now has a market cap of 2.8 trillion. So that's
Mhm.
obviously Amazon. So again, short-term hype can actually lead to very bad decision making, unless you think about your longer term plans. Geopolitical events, we've got lots of geopolitical events, obviously 9/11, um, back in the early noughties. And then throughout the noughties, we had a global financial crisis. And that's where some of the asset classes fell by around 50%. And I don't know if you were an investor back in the sort of 2007, 2008, 2009 era. And if you remember how you felt about watching your values go down and down and down, and also I suppose the decisions that you might have made. But again, one of the key principles we learned there is that staying invested following a deep crisis can actually sometimes be the best thing to do. And I'll touch on that a little bit later. Throughout the 2010s, 2020, we had that vote in 2016 with the Brexit vote, quite localized to the UK, but there was a short, sharp fall in the UK markets of about 15%. But again, quite a quick recovery afterwards as far as investors were concerned. But it plays havoc with our emotions.
Mm.
Um, the next event I'm going to come on to is probably a unique event in my career, which was COVID, because it wasn't a geopolitical event. It was a natural event, and for the conversations that we were having with clients back in 2020, it wasn't about what's the value of this or what's the value of that and how much money have I made or lost. It was more about, are you safe? How's your family? How's your health? Because all of a sudden, this emotion, it was fear that I think we all had, and I'm sure you'll remember that. And it was a deeply tragic time for a lot of people. But for investors, as I say, my experience was it was less about the money they were making or losing. It was more about, am I going to survive? So that was quite a different set of emotions that came about in that era. Coming forward out of COVID, we had the inflationary shocks in 2022 following that mini budget. And again, the sort of investor behavior following that. And then obviously Russia going into Ukraine, there was a geopolitical event. And again, that's shockwaves through energy prices. And more recently, we've had obviously the tensions in the Middle East really since 2023 with Israel and Gaza. And now more recently, the US and the US and the Iran situation. So
Mm.
when we look at investments, the sort of impact of events could be geopolitical, they could be a policy mistake, it could be an asset bubble, it could be a natural event. But the other sort of event that plays absolute havoc on our emotional ability to make a sensible decision is a life event. So these could be really happy events, so a birth, a marriage, maybe a retirement, a windfall. You might have sold your company, you might have won the lottery. All of a sudden, your emotions take on different sort of levels, and that can really impact on your decision making. Of course, the opposite of a happy event could be a sad event. So a divorce, some people might say that's a happy event on one side, but let's assume it's a sad event. A divorce, maybe a sudden and unexpected bereavement, a sudden redundancy, or actually something which is very, very common with a lot of people is health. You get a phone call from a doctor, and it's not good news, and all of a sudden your whole concept of long-term planning just goes out of the window, and that can play absolute havoc on investment decisions. So I think the first way or the first takeaway, Esther, has got to be that uncertainty and volatility, whether it's in a market or a life event, is an absolutely normal part of investing, and you don't always have to fear it.
Good. Well, that is comforting to hear, David. So when markets do become more volatile, as they sort of have been of late, I think many investors are quite tempted to try and time the market and get in there when it's low. But does that actually work in practice? Are there more successes or failures in that behavior?
Uh, there's probably two ways to answer that question. So that the first one I'm going to answer is let's have a look at the opportunities that actually market volatility can present, because there are definitely some opportunities. So you mentioned about should market if markets have fallen, should investors try and get in whilst it's a little bit lower? So if you're an investor that's sitting on surplus cash and you're thinking about going in, one of the most common errors that people make when markets become a little bit wobbly is actually, I'm just going to wait until the markets settle. Now, what you're saying is, I'm going to wait for the market to go down and the market to go back up again, and then I'm going to put my money in. So it definitely gives you an opportunity. If markets have a sort of a short-term fall and you've got a long-term plan, you can actually buy into the market at a bit of a discount, which is a great opportunity for long-term investors. Now, the other opportunities that market volatility also creates is maybe if you're already invested in the market and you are looking to maybe rebase some of those investments because of tax implications, or restructure those investments. If there's been a sudden short-term market fall and your intention is to rebase the investment and buy back in something very, very similar, it could be a good opportunity, because you're creating a tax point with a slightly lower profit, therefore slightly lower tax, and you're getting back into the market, probably into a very, very similar investments, maybe in a different structure. So, legislation changes over time. So what was a really good investment structure 5, 10, 15 years ago might not be suitable today because of tax legislation, or indeed your circumstances. So this might be looking at unwrapped investments going into maybe an investment bond, or other sort of planning like family investment companies. And at Moore Kingston Smith, we've got a lot of specialists that can help on family investment companies. So if restructuring is something you're interested in, please do reach out. Probably the more common sort of rebasing that people hopefully do every year is just moving money from an unstructured investment environment into something like an ISA, which is a tax-free environment. So, I think about the last couple of months when we were, talking to lots of clients about selling out of some of their investments towards the end of the tax year to use some of their tax allowances, getting ready for the beginning of the tax year to move it into the ISA. We sent those notices out probably in February. Markets had dropped a little bit by the time we'd actually done it in March. That meant that we were able to sell more of their investments and get it into that tax-free environment. So as that recovery sort of happens, and for longer term investors it does, they've moved that into a tax-free environment. So I think the second takeaway about market volatility is sometimes market volatility can actually present you with really good planning opportunities. So don't overlook those.
Mm. I mean, obviously, there's the whole thing about reacting to the short-term market movements, and you sort of cautioned a little bit there. So sort of explain to us a little bit how that can be sort of damaging to long-term outcomes.
Yeah, absolutely. I'm going to throw a couple of charts up here. The first one I've got to because we're talking about numbers and things, so I've got to put this chart up. So just make sure I get the right screen up here. Um, Hopefully we've got something showing there for everyone. So this is just
Mhm.
a regulatory warning. Obviously, as Esther mentioned, this isn't personalized advice. Investments can go up and down, and you might lose some money on investments. But what I really want to talk to you about is where we've got short-term volatility. This can have such a horrible impact on your long-term plans if you make knee-jerk reactions. What I've got here is I've cobbled together data from various different sources. So I've had to use a few roundings. I've had to use some currency conversions. So don't focus too much on the numbers. This is really about the principle. I've used the S&P 500 as the index. So that's 500 of the largest companies by market cap in the US. And I've had a look at a 30-year investment period. So investments are all about long term. And this is running up to the end of 2025. Now, what this chart is showing is that if you were a disciplined and sensible investor, you'd put your money in 30 years ago and you had a plan and you left it in there, you'd actually got quite a reasonable return. It's a little over 10% annualized each year if you'd left everything invested. Now, we know that we're humans and we're not always rational. So in times of severe market volatility, you might have got nervous, and some clients might have sold out because they got nervous and they're going to wait for the markets to settle. Over that period, if you had missed just the 10 best days, and bearing in mind that 30 years is just shy of 11,000 days, and you've missed just the 10 best days, your returns could have gone from, circa 10% annualized down to about 7.5%. And you might think, well, yeah, 7.5% annualized is pretty good. However, with the power of compounding, if you have a look at what the value of your investments could have been if you'd left it
Mm.
invested compared to if you'd panicked and sold out, you might have over halved your wealth. So it can have an absolutely catastrophic event or catastrophic impact on your long-term planning. There's also the stats there for 20 days and 30 days, and missing out on the best 30 days over 30 years, well, you're only just a little bit above inflation.
Mm.
So I think the key lesson here is the best days are they're rare and they're unpredictable, and they're probably going to happen when there's the most volatility in the markets. So I think the third takeaway, and I'll stop sharing this screen now. The third takeaway for you to consider is if you invested, don't try and time the markets. You're probably going to get it wrong. If you do get it right, it's going to be luck more than judgment, and it can have a catastrophic event on your longer term planning.
Mm. So we're saying that by trying to time the market and by playing around and keep extracting and going in, out, you are possibly going to miss some of those brilliant days that you should be invested for, and that could compound and have a significant effect on your long-term investment.
Absolutely, yes. So I think that when we can have a look over most time periods, it's the same sort of outcome. If you manage to time the market, as I say, it's luck more than judgment.
Yeah, yeah. So what sort of you talked about sort of different lifetime events, good or bad, triggering different emotional behaviors. What sort of emotional behaviors do you most commonly see that sort of lead to investors making poor decisions?
Yeah, I think the most common is going to be fear and fear of the uncertain, and that's completely natural. Over the decades, there have been so many studies on investor behavior, and this has sort of gone into behavioral finance and more sort of psychology rather than numbers, and it's very interesting. There's a couple of academics, Daniel Kahneman and Amos Tversky. They've done a number of studies, and one of them is something called the prospect theory. And this, I think, was back in the 50s. So this isn't new, but there's always studies going on about how our emotions can drive our decision making. And part of the biggest problem is humans are not rational. Okay, we feel first and we think second. And so when that comes to investors, we're emotional, not logical. And sometimes we will let our emotions take over, especially when we don't have a good long-term plan. Fear, either the fear of missing out or the fear of that uncertainty is a
Mm.
key driver. And some of those studies, what they've done and how they've calculated this, I'm not entirely sure, but they have a look at loss aversion. And what the studies show is that a loss hurts more than twice as much as a gain feels good. Now, as I say, I don't know how they came out with that formula, but I can relate to that, and I'm sure a lot of you can as well. So the fear of missing out is obviously, a key issue. The fear of the uncertain, and recency bias as well. So what has just happened will continue to happen. And I've got a great example of this. So I'm one of the lucky ones that 5 years ago I took a lovely mortgage out that was virtually free. And at the end of this year, it comes up for renewal. And I'm a pretty good saver, I'm a good investor, and I'm a disciplined investor. And so I'd always planned that actually I was going to move my money out of anything that might be a little bit wobbly into something which is really dull and boring. But I was having a look at how my investments have performed in 2025, and I thought, oh, this is really good. If this keeps on going like this, I'll virtually have no mortgage by the end of the year. And I thought, hang on a second, David, what would you tell your clients? And I'll be telling my clients, you've got a long-term plan, you have to stick to it. So earlier this year, I sold out of anything that could be wobbly. I bought a really boring government gilt. I'm still going to make more money on those investments than I'm paying on the mortgage, but I stuck to my plans. And actually, I'm pleased that I did because obviously with volatility now, I would have been in a very, very different position.
Mm.
The other
Mm.
sort of behavior is sort of following the crowd at the possible worst time. So, lots of examples. I think, more recently it was at GameStop, I think one of the shares, and it was social media that was driving this hype about certain companies. And so lots and lots of people piled in, and all of a sudden the supply and demand just changed, and a lot of investors lost out there because they were following the crowd. Do you remember the queues around Northern Rock? Now that was slightly different, but that was fear. People
Mm.
were scared about that. So herd behavior is one definitely to watch out for. The present bias as well, what's going on today. So it's short-term thinking versus, your long-term benefit. And that really goes back to that previous chart that I showed you that, over the longer term, if you think in short-term chunks, that can really, really impact your long-term plan. And again, that ties in with overconfidence. I can time this. As I say, if you do manage to time the market, it's not a sustainable strategy for investing. You might get lucky once or twice. At the very beginning, Esther, you mentioned about the noise. There is so much noise out there, and we've all got one of these, and it's actually quite dangerous for an investor because the media is not there to necessarily give us good news stories. I think that's with the exception of the local media, and sometimes you hear about Kitty being rescued by Fireman Sam out of a tree, but more often than not, it's markets have fallen, this has happened, this conflict is going on, inflation's going, might rocket, and that sends shivers through our emotions, and that can really impact on our long-term decision making. So I think the fourth takeaway has got to be try and keep your emotions in check when making any sort of investment decisions. Knee-jerk reactions can be really costly, and I showed you that on a previous slide. And one way that you might be able to counter or reduce the impact of your emotions on your investment decision making is actually outsourcing that decision making, because that really
Mm.
helps to remove the impact of emotions.
That's good. Good advice, David. Good advice. So, kind of, when the markets are uncertain, like they are now, I guess, is it better to sort of invest a lump sum or to sort of trickle your investments in over a period of time?
Yeah, I think this is a toughie because there's no right or wrong answer because that needs the crystal ball about what the best outcome was. If you had a lump sum today and you just put it in the market and the markets just went up, then obviously you would have been better off just putting it in one go. Because there is uncertainty, and there will always be elements of uncertainty, if an investor is scared and nervous about putting something in one go, then you can stagger those investments. And there's a concept called pound cost averaging. Um, You can either do it with sort of single investments by spreading it over maybe two or three different tranches into the markets. But the most common experience that most investors will have had with pound cost averaging is probably your pension fund. If you've paid into a pension and you pay in an amount every single month over 10, 20, 30, 40 different years, one month your investments that you've got are worth a certain value. So your X £100 a month goes in and it buys at that value. Now let's assume that the following month the investments have fallen in value. Now you might be a little bit upset that your value has gone down in a month, but your £100 is buying in at a cheaper price. Now, a pension fund, as the example, is a really long-term investment. So what happens today for a lot of people who are retiring in 20, 30 years' time, it will have little impact. But actually, pound cost averaging, it's it's one way if you're a nervous investor to actually get into the market. So I think one of the takeaways there, Esther, is going to be you can eliminate investment timing risk, but there are certain things that you can do to reduce it.
No, absolutely. Otherwise, you're relying a lot on probably luck to time it at the perfect time, which is going to be unlikely. So people talk a lot about stock picking, get excited about, I don't know, penny shares as well, that have huge amounts of volatility, and if you can get in when it's low and sell when it's high. So what's your sort of thoughts on whether sort of investors should sort of, I guess, spend any time trying to stock pick or any time trying to identify particular sector trends, or is it kind of broader asset allocation that's more important in the long term?
Absolutely. So I think, we would all love to be able to pick that best performing single investment year in, year out, buying at the right time, sell out at the right time. But in reality, that is going to be impossible. And very few, and I'd argue if anyone, has actually really succeeded on that. And if you're on this call and you've succeeded that, I'm not sure why you're on this call because you should have got a lot of wealth there. And how investment portfolios are actually made up, really does depend on the individual, the circumstances, approaches to risk, the long-term objectives. But our advice is generally that we'd start with asset allocation. I'm going to pop another chart up here. And this is a chart that I absolutely love. It's a chart that I call a patchwork quilt, and actually commonly it's known as the asset quilt. It's maybe something that belongs in the Tate Modern, or it's now. Don't worry about the detail on this chart. I'm going to talk through the principle here. Now this is designed by, or this particular version is JP Morgan, so it's quite US centric. So a lot of the asset classes it's talking about are US centric, so large cap US stock or small cap US stock. And what this chart is showing, it's going over a 15-year period. So from left to right, after column 3 is the year. And actually, if I can use my skills here, I can put a little cursor. So along here, we've got the years. Each of these different colored blocks is a particular asset class. And if the block is at the top of the screen, then actually it was the best performing asset class in that year. And down, if it's at the bottom of the screen, it was the worst performing asset class in that year. And it goes year by year. And I think that, what I'd like to show you is the fact that there is no logical pattern or trend that comes out from this about what is the best performing asset class in each year. It goes from 2011 to 2025. Year to date is up until the 31st of March this year. And what it's showing is if you tried to guess what the 2027 color order might be, can you guess how many different sort of permutations and combinations there might be for that, Esther?
Infinite.
Well, yeah. I don't know if you remember those formulas back from school days, but there's about 3.6 or over 3.6 million different potential combinations about what that next column, the order of those different colors. So when you're saying, you want to try and pick the best thing, well, just getting the right asset class, you got to be picking, potentially, out of 3.6 million different options. What this chart also shows is actually over the longer term, over here, what the order of those asset classes annualized, and then the risk you would have had to take in. So volatility is one measure of risk. And if that sort of color is at the top of the chart, then that's the most risky asset over that 15-year period. And if it's at the bottom, it was the least risky asset using volatility as a measure. Now, one thing you'll notice in the middle is this sort of asset allocation model, and this is something that JP Morgan have done. They've used approximately 75% in equities, so that might be a medium to a higher risk or longer term portfolio. But what it shows is the variation of using an asset allocation model. As far as long-term returns, it's towards the top of the table. And as far as the risk you had to take, so the risk adjusted performance, the risk was towards the bottom of the table. So generally speaking, our advice would very much be to have a look at, I'm just going to stop sharing that chart now. Have a look at a well-diversified portfolio. And the reason that we do that is because it does help protect investors from market volatility. It also potentially helps to increase the long-term returns, and that's because different asset classes sort of behave differently to each other, so their relationship are different. Some have a positive correlation, so equities will generally move in the same direction around the world. But certain asset classes have either a negative correlation or sometimes zero correlation. So it doesn't matter. So, oil prices and gold actually have no relationship to each other. So by blending different asset classes using diversification, you can actually reduce your potential risk and increase your potential returns. And obviously, a well-diversified portfolio is always going to limit your exposure to any one, single investment or single asset class. So it gives you peace of mind so that, investors, you focus on your long-term goals and not the daily headlines, as you mentioned earlier. So I think, the next takeaway is don't put all of your eggs in one basket, have a well-diversified portfolio.
Thanks, David. Just to remind everyone to ask questions if you want to ask questions. I haven't seen any yet, but please do chime in. And David, I'm going to add in a question of my own when we're looking at sort of stock picking and sector trends, and dare I mention it, AI. To what extent do you think AI may be able to, in the future, actually get some of this right and help people with investment decisions? Will it be
Well,
able to stock pick?
um, so we always say that, look, past performance isn't going to be a guarantee to what happens in the future. We can identify trends, and the thing I'll say, Esther, is that forms of AI have been around for a number of years. Although it's more prevalent in our day-to-day lives today, there's always been forms of AI, and actually to date it hasn't got it right. And if it had, there would be a lot more people who've got an awful lot more wealth purely through investing. So I think I'm not going to say AI is never going to be able to predict accurately what might happen, but I'd say today, just take it, be very, very cautious. If you put something into any AI model and it says, yes, you should go and invest in this company, don't invest more than you're prepared to lose, because it could be wrong. So I think just be a little bit wary about AI and can it predict the future.
Yeah, good advice. What about cash? What role does that sort of play during volatile periods, particularly when investors sort of feel tempted to panic sell?
Yeah, cash is really important. Everyone needs cash to pay their bills, and so from a planning perspective, we always say you've always got to have an emergency fund, and that could be a place to turn in times of volatility. It could be if the roof blows off, the car blows up, and you need to be able to grab something without necessarily selling something. Now, a good amount of an emergency fund is going to be very, very dependent on your own circumstances. Say for a lot of people, when they're still working, they've got money coming in at the top, and that generally pays the bills. So people will tend to have a slightly lower emergency fund, maybe 3 to 6 months net expenditure. A very cautious investor might actually have a much higher level in cash, because that's where they feel more comfortable. It changes during lifetime as your circumstances change. So, for example,
Mm.
when people move into retirement, all of a sudden there's nothing else coming at the top. So their focus moves from accumulation and growth into probably wealth preservation. So that's where people's attitude to risk may well change. And that's where we always advise, well, maybe have that slightly bigger buffer, that in the event there's periods of short-term volatility, you're not first forced to turn to your investments and actually sell out. Now, if we think about the period from, let's say, 2010 up until sort of middle of COVID, we had very, very low interest rates, and there was an aversion from a lot of people to hold significant amounts in cash because it was doing nothing. It was losing money in real terms with inflation. But actually, as disciplined planners, we still said, look, you've got to have that buffer. And actually, it was good they did, because the main bit of planning advice that we gave to investors in 2020, shortly after the sudden market falls, was, look, this is when you need to stop taking money out of your, whether it's your ISA, whether it's your pension or other investments, and move to cash. Let your investments recover and look after themselves. Turn to your cash pot
Mhm.
to actually fund that
Mhm.
income, because your bills are still going to, come in. They still need to be paid.
Mhm.
2025 was also interesting because there's really, really good periods of profit for a lot of people. So the sort of conversations that we were having were, okay, well, look, you've made some good profits. Why don't we start building up your emergency funds? And this is really more, I think, relevant to those people who are in retirement, and maybe they've got a pension fund. They don't have a guaranteed income from it, and they're drawing from their investments. So part of what we did is we didn't say take the money out of that wrapper. We just said put a sub wrapper in there, which is cash. Now we can earn some interest on cash. It's broadly going to be, sort of keep pace with inflation, but it just means that if that volatility and that uncertainty continues, it's going to give that person in retirement peace of mind. Okay, and they will not, need to allow their emotions to make their decisions. So I think, the
Mhm.
next takeaway point there, Esther, is always have an emergency fund,
Mhm.
and don't be
Mhm.
shy to take profits. That, unless you've sold something out, you haven't made a profit or indeed a loss.
Yeah, no, absolutely, absolutely. You talked earlier about sort of major lifetime events, some happy events, some sad events. How should those major sort of lifetime events influence your investment decisions during sort of times when the markets are particularly turbulent?
Yeah, absolutely. So I think, life events are probably going to have a larger impact on your emotions than other events that are sort of, completely outside of your control. So, I mentioned earlier that, yeah, they will play havoc on your emotions, and it's really, really important to have a plan and avoid making those rash and irreversible decisions. The the easy or the easiest example that people can relate to is going to be probably in that run up to retirement, when there's no more money going in at the top of the pot. Your emotions are going to be, more emphasized if global events are, impacting your asset values. So your emotions will be heightened. We spoke earlier about pound cost averaging when you're putting money in and trying to, remove some of the investment timing risk. The same principle applies when you're taking money out. If if 1 month you take your money out and the market's here, that's great. But the next month, if your market's here, you've got to sell more of your investments to get your same monthly income. So that's why, as I mentioned earlier, building up that higher emergency pot and having that slightly different approach in decumulation from an investment
Mhm.
perspective is really important. We know the time horizon shortens. Your ability to absorb those losses, so the capacity for loss, is also going to reduce. So I think simple rules with life events are going to be, you know, if you know an event is coming up, start planning early. I gave you the example about paying off my mortgage. I start planning early. In retirement, think about all the options. If you're going to use your pension pot to buy an annuity, make sure that that part of the fund is not subject to short-term market volatility as you approach retirement. So looking at probably at least 5 years out, to start planning, sometimes more. And there's going to be a lot of people out there, maybe in their early 50s, who 15, 20, 25 years ago, they went into the workplace pension scheme and they were given this lifestyle fund. And that was great because it was going to look after itself. And as you got to retirement, it was going to make sure that you were in the right sort of investments. However, a lot of those lifestyle plans assume that you're going to use your whole pension fund to, number one, buy an annuity after, number two, you're taking your 25% cash out. So a lot of people are in a fund that when they hit their chosen retirement age are going to be sitting in 25% cash and probably 20 and 75% in gilts. That could be completely unsuitable for you and your circumstances. So I think, again,
Mm.
make sure you're reviewing those things, do it one in advance.
Mm.
In retirement, hold a little bit more cash than maybe you do on the way
Mm.
up. And I think importantly, regularly review it for sustainability if you're in retirement. So
Mm.
We use cash flow forecasting. It's absolutely brilliant because you can put lots and lots of different scenarios in. But again, remember, it's out of date as soon as you close the computer down because you've used so many assumptions. So regularly
Mhm.
reviewing your plan for sustainability is really, really important. So I think the takeaway there in the run up to or following any key life event, never make a rash decision because it could be irreversible, and actually revisit your plan regularly.
Absolutely, absolutely. So tell us, David, how does good financial planning help our investors sort of cut through the noise, manage all these emotions that we've been talking about, and really kind of stay laser focused on the long-term outcomes of their investments?
Yeah, absolutely. I think right at the beginning, I sort of mentioned about my experience, and although as a financial planner, yes, there's lots of technical things that you have to know behind the scenes, but a lot of it is about almost becoming a behavioral coach for clients and having a look at the psychological impact of whether it's a market event, whether it's a life event for that individual. So working with a good planner, number one, is going to really, really help you to create a plan. You've got that anchor point, you've got that target destination, and you can then plan that journey. Now, we know that throughout that journey, there are going to be periods of uncertainty, and uncertainty can really derail a really solid plan. And that's normally because of emotions, not because the plan wasn't good, but
Mm.
because actually you've allowed your emotions to start making those decisions. So a good planner will act as a really good sounding board, and as I mentioned, like a behavioral coach. They're going to help you keep focused on what your goals are, and they'll provide, I think, discipline for that as well. We've spoken about the noise before, and these things are so dangerous. On one side, we're so well connected. On the other side, we've got so much information; it can be absolutely overwhelming. And so, be careful of that noise. Be careful of that news. I mentioned about earlier that you never ever get good news. Can you remember the last time on, the news at 10 that the anchorman or anchorwoman said, and actually there's been a completely unremarkable day on global markets today, and there's absolutely nothing to worry about. Over to you, Carol, with the weather. It just doesn't happen. We don't get that sort of news. Um, Throughout your lifetime, your circumstances are going to change. And that could impact the plan. Now, it might be little incremental changes, but it's really important to review that plan, and working with a planner, that will be done on a regular occasion. Legislation changes. That changes all the time. I mean, the big change for a lot of people coming up is, April next year, the pension fund, which for most people, or certainly for a lot of people, could be their biggest single asset that they own, all of a sudden becomes part of their estate for inheritance tax planning. So for the last 10 years, lots of planning has been, you've got this wonderful asset, you might never need it, but we'll keep it there and then it can pass down to the children. Now what we're looking at is actually, do you need to strip the money out of that in a controlled fashion? So working with a planner is going to help you keep disciplined. It will help you keep up to speed with legislation. It's going to present you with those opportunities, and it's going to, I think, prevent you from making really bad decisions which are based on emotions and not logic. So
Mm.
I think one of the things to take away is going to be biggest risk to your wealth isn't necessarily the markets. It's going to be how you react to it. Um,
Mhm.
don't let your emotions decide drive your decisions. Market uncertainty and volatility is absolutely normal. Stay invested and look for the opportunities as opposed to fearing it. Stick to your long-term plans. If you haven't got a plan, it's really important that you do get a plan, but stick to it and regularly review it. Ignore the short-term noise. It will not really have a significant impact on your long-term plan unless you react to it. So don't try and time the market. And I think, working with a good financial planner will help you follow these principles and that discipline.
Mhm. Thank you very much, David. We have come to the end of our webinar. Some really, really useful takeaway points there, which we will be summarising into a document which we will circulate to everybody. So thank you all so much for attending. I hope you've all learned a lot this morning. Obviously, don't let emotions guide your investment behaviour, being the one I'm hearing very, very loud and clear. Please do fill out the feedback form. We will send it to you. Super useful. And please do, like I say, share this webinar recording when we send it to you, to anyone who missed it today. Other than that, thank you very much, David. Thank you very much
Thank you.
to everyone who's joined us this morning, and enjoy the rest of your sunny day. Thank you.